Well, we're going to talk about the trends developing in the financial system this week. Trade wars. Trade wars are at the center of the trends developing in the financial system right now. Donald Trump's trade wars with China. Now, China's kind of lashing out. A lot of people don't know it, but lashing out behind the scenes at Donald. They gave him a slap across the wrist this week. They sold U.S. Treasury bonds. The U.S. 10-year has went up quite substantially. It's at around 3.07% for the U.S. 10-year right now, and this is a trend we see developing. The Chinese don't really have that much more at their disposal other than to sell U.S. Treasury bonds to try to slow the United States down, to impact the United States, to try to get the United States to relinquish on these trade on these issues. In fact, the Chinese won't even sit down at the trade table right now with the United States. They're very upset at the United States. And part of the reason why is Russia was selling some armaments to China and China to Russia. They've been selling back and forth. The United States is putting trade embargoes on these trades back and forth between Russia and China. And China and Russia, they both think that this is completely over the top. Why they can make deals with each other, they think that they should be able to make deals with each other with the United States with not horning in. And they feel like this is over the top. So them selling bonds, they have I think it's 1.14 trillion or something like that of U.S. Treasury bonds at their disposal, the Chinese, that they can sell into the market. Now, at the same time, we see the trend developing with the Federal Reserve. They're stepping it up a notch. $50 billion worth of U.S. Treasuries. They're not selling those Treasuries. What they're doing is they're rolling them over. And basically what this means is they're rolling them over and taking the money, the liquidity, from these maturing bonds off of the board. The board being the world marketplace. They're pulling these dollars out. Basically what they're doing is they're sucking dollars out of the system. This is artificially creating a scarcity of dollars. This is smacking really hard the third world countries out there that are what they call emerging markets. Now, some of them aren't third world countries, but they're the emerging markets. They're the rest of the world. Take the capitalist West. What's the rest of the world? The rest of the world is the emerging markets. It even includes some of the countries that it's a very large. There's like 12 countries involved here right now, but soon it's going to probably be escalating into more like 20 countries involved as this escalates. This is going to escalate very soon, this emerging market crisis, because of this liquidity that the Fed's drawing out, raising interest rates. At the same time, these tariffs that are being put on all Chinese goods are going to raise the costs in the United States. Like if you go to Walmart, you're going to see those Chinese shoes go up 25% higher in price. It's going to make American goods more competitive, but it also raises the specter of inflation on consumer goods. Across the board, this is what the Fed's looking for. The Fed's looking for inflation to increase so that the Fed can continue to withdraw liquidity out of the system. So we've got a strange set of workings going on here. And what's happening is as all of this is starting to impact, the impact's starting to be felt, trends are starting to develop. Now, what my job is to get out there 4 hours a day and do the research into these developing trends and then report it back to you guys with a show every day, right? That's my job. And I take my job very seriously. And so what we're going to be doing is because these trends that develop could actually take down the entire economic system right now, I have to really stay on top of this because this is an unfolding thing that's very, very important. that you guys get this information about these trends that are developing in the financial system. And most of it has to do with the Fed. The Fed is what's pushing these trends. And it's all got to do with this $50 billion every month that the Fed, and this is dollars that they're withdrawing from the system. They're sucking it out of the system. You have to understand that at the height of quantitative easing, when the Fed was injecting liquidity into the system after the big crash of 2008, they were injecting $80 billion at the peak of injections into the system. They were injecting $80 billion a month into the system. Now, right now, they're withdrawing that same money out that they put in. Now, if that money was what brought us up from the crisis of 2008 and stabilized the financial system, what do you think is going to happen when they actually decide to do the reverse of that and withdraw that money out of the system again? Well, we're going to collapse back into the same situation, if not worse, than we had in 2008. This time, in fact, it's going to be worse because debt has exploded since 2008 until now. We've seen an explosion in credit. Debt is credit. Debt is the reverse side of credit. And so all of these banks run on credit. This is where we're a bank out there right now where they show you their tier 1 capital and they say, oh, we've surpassed the bank stress test and everything is rosy now because we've got all this tier 1 capital. What you're going to find out is all of that capital is actually debt. What's happened is they've loaned money out. Say they loaned money out to Mr. X. They're expecting to be paid back from Mr. X. That loan that they loaned out to him, they created that money from nothing. It's called fractional reserve banking. And basically how it works is Mr. X comes in and says, I want to borrow $10 billion from your bank. The banker says, great. And the reason why they say great is because as soon as they write that 10 billion, I should say, down on a piece of paper and loan it to Mr. X, that money springs into existence. And now the bank has that money as capital. Not just the money as capital, also the interest that that money is going to make as capital. And this is why they made so much money in Europe when they had the big crisis. Italy was so-called going down, so was Greece, and all these countries are going down. These countries all loaned. They loaned them out money, and that money created money that the European Central Bank can count on their books as their capital. So they increase capital. That's the profit that the bank makes, is this increase in capital. Well, when the financial system shrinks, breaks down, and it all starts to fold in on itself, that's capital destruction. That capital disappears. Trillions can disappear overnight. Now, there's certain economists out there that see this. I'll name one, Harry Dent. He can see this, and he's very bright and very, very smart economist. I don't really want to get into too much detail about how he might be actually wrong about this. And I'm going to get right to the point of where I think he's wrong. What he's not seeing is he's not seeing the reaction of the world central banks to this deflationary event that's coming. He can see the deflationary event coming. I can see it coming too. And basically what it is capital drying up. Money drying up, and all of this debt that was created drying up overnight. And it leaving the banking system high and dry. It's not going to be left high and dry for very long because that's why they call them too big to fail. They can't let them go down. They'll have to prop them up with further injections of liquidity. It's just a matter of breaking the back of the central bank. Right now, the central bank, they're on a mission. They're on a mission. Their mission is to get out there and drain the liquidity out and balance their balance book. We're going to drain $50 billion. We're going to do this and we're going to do that. We're going to drain $50 billion a month out of the system. And we're getting away with it. Look, we're doing it. And blah, blah, blah. Until it breaks, until the system breaks. Until the capital all dries up. Until their banker buddies start to actually get threatened and going under. The banks are going to go under. Then you watch how quick attitudes will change in these institutions. Watch how quick they turn from hawkish to dovish when the poop hits the fan. Just watch how quick they change their monetary policy. And when they change that monetary policy this time, all confidence is going to be lost in the fiat currencies across the board, especially the emerging market fiat currencies. And what do you think they're going to turn to? Well, in the old days, there was nothing available for them to turn to except gold and silver in this kind of a crisis. And the country didn't have gold and silver, then they were out of luck. Now there's new digital gold and silver, and that's what they're going to turn to. Simply, that's what they're going to turn to because it's available, it's there, it's ready, it's waiting. And that's what Argentina's already doing right now, right this moment. Let's just start the charts right here and take a quick look at this. In Argentina, investors flock to safe haven Bitcoin. This is not, I don't think this is the government. This is just people in Argentina. But they can act in a bigger way than the government if all the people actually start to all flock in the same direction. This could be repeated. This could be a developing trend that could be repeated in country after country after country as the whole thing just folds like a whole bunch of dominoes going down. So this is starting to happen in real time right now. I got to stay on top of it. I got to report it to you guys as it happens. So as it happens this Sunday, this is what's starting to happen. These are trends that are starting to develop. I'm going to be researching them all week in depth to try to find out what's going on with all this. Thank you guys for listening. It's been your weekend report. And you guys have a great rest of the weekend. Bye-bye, guys.